Oregon Cash Flow Pro offers free money management advice to help you take control of your finances. More wealth, less debt, fast. And now here's your host, personal finance enthusiast and licensed insurance broker, James Barber.
Today, we are going to do a deeper dive into a case study with dynamic banking, utilizing a home equity line of credit to really attack this debt and make the most out of our cash flow. Let's jump right into this here. You can see here we've got $5,000 income, $4,000 a month expenses. We've got $340,000 in debt, and cash flow $1,000 a month. We've got a credit card at 18%, $140 a month. We call this credit card 2. Credit card 1, $5,000 balance, $75 a month payment, 14% interest. We've got an auto loan, $360 a month, $28,000, 4% interest. And we've got a mortgage, again, 4% interest, $300,000 balance, $1,432 a month. We're going to be utilizing a line of credit that has a $15,000 available balance, and the interest rate is 6.25%. I'm going to talk to you just for a minute about what's going on here and what we're planning to do. With dynamic banking, utilizing this line of credit, what we're going to do is we're going to put a big chunk of the line of credit at the credit cards to begin with so that we can free up that cash flow and stop paying that really high interest rate. Okay. Yesterday's video, we talked about how utilizing dynamic banking by depositing your paycheck right into the line of credit brings our average daily balance down by quite a bit. You can see that here at the bottom of the screen. And I'll just briefly touch on this again. We got $7,000 balance to start out with. Our payday comes in, it goes down $5,000. Halfway through the month, we pay our mortgage. And then at the end of the month, we pay off a credit card that we've been using to live on because we can use that interest free throughout the month. And that ends up bringing down the daily balance. In this case, our interest for the month, because this new daily balance it will end up being between $11 and $37. In this case, our average daily balance was around $3,700 a month, and our interest charge is about $20 for the month. So we save on interest just by doing this, but with the whole strategy of dynamic banking, we end up saving a boatload of interest on everything, and we pay it off really early. Jumping into this, here's you can see my note up here, credit card. We want to pay it off each month, whatever the billing cycle is, so that we don't end up paying any interest. We use it for all expenses possible and earn points if you can. Those are free points if you pay it off each month. So try and use a rewards card, get the best rewards you can, however you think you're going to use it. Cash back's always good because you can put that right at the debt you've got. To begin with, we've got this $7,000 balance and we've got this $5,000 balance, credit cards 1 and 2. So we want to pay those off right away because these are really high interest rates, especially compared to the line of credit. Now, when I'm trying to decide which order we're going to pay things off, we always want to look at the high interest first, but we're also going to compare how do these interest rates compare to the line of credit. If the interest rate is a lot higher, then we're okay to take a big chunk of the line of credit as long as we leave some space available for emergency fund. We're never going to use the whole line of credit. We want to be a little bit conservative when we take our chunks, but if we're attacking a high interest debt like this with a low interest line of credit like this, we're going to knock that out the first month. What you see here, we ended up doing $12,000 first month chunk to credit card 1 and credit card 2. which frees up $215 cash flow each month. So our cash flow goes from $1,000 a month to $1,215. And we're going to see how that gets impacted here. We've got our totals. We pay this. Our balance goes down. If we utilize the line of credit like this, where we deposit our paycheck in, pay our bills throughout the month, we end up with $1,215 less at the end of each month. Okay, we go through month 2, we're down to $9,570. Month 3, balance drops to $8,355. Month 4, $7,140. Month 5, $59.25, and month 6, $47.10. So 6 months, we've brought the balance of the line of credit down below our monthly income. Now we want, in order to maximize the use of this line of credit, we want to be able to put all of our income into the line of credit each month. What I set this up as is anytime this balance drops below $5,000, we're going to throw another chunk at a larger debt. One of the things you're going to notice is now that we've got those credit cards paid off, or we've got this next chunk coming in, we're now shifting from attacking high interest debt to lower interest debt, lower than what the line of credit is. So we're going to change our strategy a little bit. And what I mean by we're changing our strategy is we no longer want to take huge chunks. We want to take smaller chunks. So the line of credit is optimized if we're paying a lower interest rate than we are if we're using the mortgage. We need to keep this balance as low as possible, preferably as close to zero as possible, because we're paying a little bit higher interest than we are on the auto loan and the mortgage. So to do that, our chunks are going to be $4,000. Okay, we're going to do $4,000 chunks. Anytime this drops below $5,000 for the month, we're going to throw a chunk at that. So month 7 is our first chunk. We got $4,000. We're going to throw that at the car. Okay, minus our $1,215, and it brings us to $74.95. And now, because I don't have any more room on my board, we're going to fast forward. It takes us 24 months. Month 24, this $4,000 chunk pays off the car, which was originally on a 45-month loan schedule, and it puts some towards the mortgage. We end up with a cash flow increase of plus $360, and now each month we're putting $1,575 extra, approximately, towards our home loan. We just keep going with it. Every time the balance drops below $5,000, throw another chunk at it. So now we're attacking the mortgage. Here's where that takes us. Okay, here's the result of all of this beauty and this effort we put in. We went with our line of credit by being able to knock out these credit cards in the first month. We said we're going to pay off in 1 month. Total interest paid on the credit card, number 2, was $105. That saved us almost $700 based on our original payback schedule. If we were just going to pay minimum payments, pay these things off, okay? Credit card number 1, $58.33 total interest paid on that. That one we saved just over $975. We paid it off in month 1. Our car loan, by paying it off in month 24, we ended up paying $1,318.65 in interest, which saved us $1,386 in interest. And our mortgage, we end up at $83,677 in interest, and it took us 11.75 years to pay that off, 141 months. This was a 30-year mortgage, and we ended up saving on interest just on the mortgage $131,929.70. At the end of all of this, the interest that we saved was about $133,000 in interest. The interest we paid is less than $85,000 in interest. Powerful stuff here. Now, what about the interest on the line of credit? Well, right here. 141 months worth of interest. At most, it will have cost you about $5,000 to $6,000 in interest. So we saved $133,000 in interest, and it only cost us an extra $5,000 to $6,000 of interest at the most. Now, if you're actually extending this out quite a bit, if you're getting those payments stretched out and bringing that average daily balance as low as possible, this number could be well below 5,000, probably, I don't know, around 4,000 if you're really running at a good speed, keeping these balances down. This is why I'm excited. I think hopefully you can see the potential in this for your particular financial situation. This puts you in control. When you pay off these debts, you're in control. You can start diverting this money to whatever's going to work best for you. You can invest it in real estate. You can invest it in life insurance. You can really start to put your money to work for you and not just be trying to beat the bank, which is where we're starting off here. It's a quick refresher on dynamic banking for you folks. We've got our paycheck that comes in, goes right into the line of credit. Chunk goes out to pay the debts. From the line of credit, we pay our bills. We pay our credit cards. And during the month, we use our credit card to pay as many bills as we can. And that's how we're optimizing the line of credit and bringing that average daily balance down.
I really want to thank you for joining us today. It's our hope to help you take control of your finances, maximize your cash flow, and reach financial freedom. If you found value in today's video, please give it a thumbs up, hit the subscribe button here along with the notification bell. That's how we know that you guys are interested, and it gets us motivated to put the next video out real quick. If you have any questions or comments, join us in the conversation below, and be sure to let us know what financial freedom means to you. Now go maximize your cash flow.